What is going on, everybody? It's Eric here with Traveling Trading. Thanks for checking out this video here. We're going to be talking about trading and taxes, and hopefully you guys will learn a little bit more. All right. So if you guys can do me a favor, because it took, a couple weeks to kind of put this together, it's all for free. If you could do me a favor, hit the like button and comment below, even if it's, just a great or even I hate this video. Doesn't matter. Just please do that for me. It'd be greatly appreciated. It'll help out other people who might need to see this video and learn something as well too. Okay. So, quick little disclaimer here. This is not financial advice. This is for entertainment and educational purposes only. Although I do have a financial background, education, and certification, every person's situation is different. So please consult your own tax professional and legal advisors in regards to your particular situation when it comes to your finances. This here video is going to be for general purposes and is for entertainment and educational purposes only. Okay. I can't say that one disclaimer that says I'm not a financial professional, because I am. So, um, and we'll talk about that here in a second. Um, you know, for those of you who don't know me before we get into it, who am I? I'm Eric Mullins, founder of Traveling Trading. I'm pretty much kind of like a Renaissance man, jack of all trades. You want to kind of say I do a little bit of everything. A little bit about my background for those of you who don't know. My degree is in accounting and computer information systems and computer science. I've worked in various different financial fields and tech fields as well too. I worked in the debt industry. I've audited for states. Um, I worked at tax firms, had my own tax firm. You know, things like that. I don't do that anymore. Basically, as of now, I'm pretty much just an avid day trader. Um, and I own a few properties, run some Airbnbs and things like that. So I'm pretty much just an entrepreneur, but again, a Renaissance man of all sorts. I have a lot of experience for someone my age that I'm usually told by a lot of professionals. So I'm probably more qualified than anyone you'll probably, listen to on YouTube in regards to this subject. So hopefully, this benefits, a lot of you guys here, and, you learn a little bit of something. So enough about me. I know a lot of you guys might be asking, well, what makes you more qualified to speak about this than anyone else? Um, I'll show you, because I am certified with the IRS, in regards to tax, and I'm going to show you guys how to be able to prove that, as opposed to your general YouTuber who's just talking about some general topics that they might have, read somewhere and give it to you in a video. So we'll jump into that here real quick. So, for example, again, how do you know that I know what I'm talking about and I'm able to talk about this stuff? I'm going to show you really easily. So most people will say this and that they're able to, do this and do that, or they have this certification, they have that certification. You guys are going to be able to actually see that I do have mine. So anyways, anyone who prepares taxes or is able to kind of speak with the IRS in regards to tax situations will usually, have to have some kind of qualification or certification to do so, especially when you're talking about other people's stuff. All right. Um, so for example, a CPA is a, CPA. There's also things like enrolled agents who, dealing with the IRS, and then there's certified professionals like myself who do as well too. And because you're dealing with, such sensitive information, you need to be able to be competent in that subject. One way professionals like myself are, you know, certified in this is, we have to take tests and all that other good stuff. But how do you, as a person who is not in this field, be able to verify that the person you were speaking to actually knows what they're talking about? Obviously, CPAs have their CPA license, and, businesses have business license to make sure that they're legit. Same thing for tax professionals. When you go to like an H&R Block or something like that to get your taxes done, that preparer, should have some kind of basic understanding of being able to prepare your taxes. They usually do about like 40 hours. It's not too much that they learn. They learn at the basic subjects of preparing taxes. Either, if they don't have the certification themselves, they usually get it through the company. Individuals like myself will have what's called a P10 and prepare tax number, identity tax number. And then companies like H&R Block or, Jackson Hewitt and stuff like that, they have what's called a CAP number, was, basically for a company to be able to prepare your taxes. So they'll hire like professionals to prepare your taxes for you. And they'll have one person who is actually certified probably reviewing it and submit it on the company's behalf. So you can look all that stuff up. How do you look that stuff up? pretty simple. For example, what you would do here is go to irs.gov and you pretty much click on, P10 information. Now, under the Freedom of Information Act, you're able to look that information up. So, like for example, with me, I reside in California. You can look at professionals in California. You would click on this here. And what's going to happen is going to pop up with a file for you to be able to download. It's an Excel file, and I'll pop it open here for you. That Excel file is going to contain all the professionals in the state of California who are, licensed to be able to prepare taxes and speak with the IRS professionally. And it'll kind of have like things like their designation, their address, and stuff like that. I was going to say I don't want to show it because it, have my address and information on there for the business and all that good stuff. But that doesn't matter. It's the Freedom of Information Act. You can go look it up yourself anyway and still have that same information. So let's see if we can find me here on that list real quick. So let's pull it up here. This is what the Excel file will look at. The easiest way to probably do it will be able to click on Find, and we'll search for my name here. Mullins. I think it's sorted by last name. So let's see if we can find me. I'm not Weston. I'm not Thomas. Teresa. Oh, hey, there I am. Oh, go back. How do I go back? Let's pull me up real quick. I'm number 56,652 or yeah, 652. But anyways, there you can see me. There's my holding company. Has the address, blah, blah, blah. Mullins Money Management LLC has a website and all that good stuff. It shows you my designation, business phone number, and all that good stuff. So that's straight from the horse's mouth. Again, you go to Freedom Information Act, P10 information. You'll be able to see all the professionals within your state that are, designated to speak with the IRS about, tax situations. So there you have it. Go look it up yourself. You don't have to take my word for it. Obviously, you're dealing with someone who knows what they're talking about. So with that being said, let's go ahead and get into this. Trading and taxes. All right. So guys, first and foremost, understand this is going to be a lot of information. So, if you need to get something right, do so. Grab you some water, some popcorn, whatever you need. I got mine. And we're going to go ahead and get into this here. So the objective for today, what I want for you guys is to be able to understand how taxes work in compliance with the IRS regulations. I want you to be able to understand possible tax saving strategies that might apply to you through possible deductions and scenarios. But ultimately, I want you to have a basic understanding of your options and tax options within your trading so that you'll be able to save yourself some money. And obviously be able to competently speak with, your professional about your specific tax situation. Because of course everyone's different. But if you have a basic understanding of things, I think you can understand enough to where you can know how it might benefit you. Okay? So that's what we're going to do here. All right. So first and foremost, let's understand how the IRS looks at taxing stocks, okay? Now, the best way to kind of put this, the IRS is going to consider the buying and selling of your stocks to either be long-term or short-term as capital gains or losses, okay? Either you're going to make money or lose money in the long-term or short-term from your stocks / investments. I say investments because technically they also mean things like not just stocks, it could be real estate, jewelry, collectibles, et cetera, but we're focusing on stocks. This is about stocks, okay? So when I say investments, just mean I'm talking about stocks, all right? So that's kind of the differences between the two, long-term and short-term. Short-term is anything that you've held less than a year. Long-term is anything that you have more than a year, okay? And that's what the IRS will classify your stocks into, either long-term or short-term. And then from there, they decide on how you as a taxpayer are going to be taxed on that long-term or short-term capital gain or loss that you might have, all right? Now, when it comes to the rates, they are going to vary between long-term and short-term capital gains, okay? Now, there's federal rates and state rates. State rates, vary depending on the state that you're in. Federal, generally to everyone in the USA. And again, this is for U.S. taxpayers only. It's not dealing with international tax, all right? So we're mainly going to focus on the federal stuff because too many states to be doing it individually. So we're going to focus mainly on the federal stuff. But what are the rates, right? So short-term capital gains are taxed just like ordinary income up to 37%. And then long-term capital gains are in a graduated threshold from $0 or 0% to 15% to 20%. Okay, and typically most people who have long-term tax rates pay on average about 15% lesser than short-term capital gains. Um, so that's kind of how that works, and that's according to IRC 409, I believe. So that's pretty much how that breaks down. Pretty simple there. Long-term or short-term. Short-term is more taxed more heavily than long-term. Pretty easy. So this is kind of a breakdown of short-term capital gain rates as of 2021. Now, this obviously would change in the future, but just going to kind of give you guys a quick sample. Now, this is according, you know, to the IRS publication. I think it's the pages like 20 through 45 there. Um, Short-term capital gains are taxed like ordinary income. So any ordinary income that you receive from this investment is held for less than a year, has to be included with your taxable income for that year. So let me kind of give you guys an example. Let's say if you made $80,000 from working your job for, the year, but you also made $10,000 in a capital gain from buying and selling a stock. You bought a stock in, you know, February and you sold it in July. It's just short-term capital gain. You made $10,000. So now your taxable income goes from 80,000 to 90,000. Okay, that you got to pay. Now keep in mind the U.S. imposes a progressive tax rate, which means basically your tax rate will increase with the income. But that would, for example, let's say if you're a single person, like I said, you made 80,000 but had an extra 10,000 from your short-term capital gains, you're going to move from this bracket to that bracket, and that's how your income is taxed. Pretty simple, okay? Now, long-term capital gains, those rates again run from 0 to 15 to 20%, okay? So as you can see, you're paying about 17% more with the long-term or with the short-term capital gain than you are with the long-term capital gain. For example, like I bought Facebook stock like when they first IPO'd, and I just sold them recently when they switched over to Meta. So I got to pay long-term capital gains on that because I've had it for some years. Um, but my tax rate won't be as much as if I would have sold it shortly. So that's pretty good. So long-term capital gains are subject to 0, 15, or 20%. Okay. Um, Now, when it comes to things like jewelry, art, precious metals, collections, stuff like that, they are subject to like a 28% tax rate. But again, we're not talking about that stuff. We're talking about stocks. All right. But this is an example. You have different brackets between those two. Pretty easy. Now we'll also talk about here, but not in too detail, dividends and paying taxes on dividends. You guys typically won't need to worry about this if you're, a day trader, more along the lines if you're an investor. Um, so dividends, basically, first and foremost, what is a dividend? For those of you who don't know, according to IRS Topic 404, a dividend is basically income you receive from owning shares in the company. Pretty simple. A company pays you for owning their stock. Um, some, dividends are given out quarterly, semi-annually, annually. It varies from, company to company. But that's what dividend is. A company giving you money for owning shares of their, you know, owning shares of their company, you get some of that profit. Pretty easy. Now, the IRS is going to tax dividends one or two ways. Okay. They're either going to be taxed as ordinary or as qualified. Okay. Ordinary dividends are taxed as ordinary income. Pretty easy. Qualified dividends are dividends that meet a requirement to be taxed as a capital gain. Okay. Now, under the current law, qualified dividends that are taxed are usually taxed just like long-term, you know, long-term stocks, 0, 15, or 20%, depending on your tax bracket, blah, blah, blah. So kind of look at it like this is kind of like a short term. Ordinary dividends are taxed like a short term. Qualified dividends are taxed like a long term. Pretty simple. So usually what happens is you receive what's called a 1099 DIV that will have the amount of stocks that are $10 or more to be reported on your Schedule K when you do your taxes. no need to kind of make note of all that. Your tax professional should know that stuff, but pretty much you'll get what's called a 1099 DIV when you get dividend stocks to be put on your Schedule K1. Pretty easy. Dividends can be classified as either ordinary or qualified, like I had mentioned. And what happens there, you get a lower tax rate when you're with qualified dividends as opposed to ordinary dividends. So, according to Topic 703, the distribution qualifies as a capital return if a corporation and the distribution doesn't have any accumulated current year earnings or profits. Once the adjusted basis is calculated, you then, and reduced to zero, any further income you have from that is taxed as a capital gain. So basically, they're just, taking your cost basis in the stock and subtracting that from, the actual cost of the stock to be able to get your capital gains. Pretty easy. That's reported on the form 8949 and I think like Schedule D. But honestly, you won't really need to know any of this. Your tax professional is going to be able to deal with all this when you take it to them, and they'll do their thing. But this is just to know that your dividends can be broken up into two different ways. Pretty easy. So let's just kind of recap this because I know it's a lot of information. What you should know by now here is simple. How the IRS taxes stock. Again, they're going to tax either as a long-term or short-term capital gain. The difference between the long-term gain, which is stocks that you hold for longer than a year. Short-term capital gains are stocks that are, shorter than a year. And then you know about dividends and how they're taxed either as ordinary or qualified. Pretty easy. So we're going to take a quick break right here. Then we're going to jump into the next section and learn a little bit more. All right, so now we are back, guys. We're going to go ahead and get into the next section here, where we're going to talk about the different ways of being taxed. Okay, so you guys know me. I'm all about, paying your taxes, of course. Don't try to skip out on it. I'm all about paying your taxes, but however, I believe that you should pay your fair share. The problem is, not many people know exactly what they should be paying and what they shouldn't be paying. To be honest with you, neither does the IRS, nor do they care. They just want you to pay. But you know what they say, nothing's for certain in life other than, death and taxes. So might as well try to fix one of them, right? But, if you could have the ability to, save yourself some money, then I think you should. Like I said, the only thing is the IRS isn't going to do it for you. They'll just assume the worst of it and tell you to pay it. But you as a taxpayer not knowing that you can qualify for this or that, definitely hurts you. So that's why we want to learn a little bit more about, the taxes and things like that. So let's go ahead and jump into that part. So basically what happens, of course, that the IRS defines, buying and selling stocks to be the long-term or short-term. It's also broken up into different categories of ways you could be taxed. Just in general, not just on your stocks, but just in general. But anyways, so they're going to pretty much kind of put you in, a few categories. And these are like the top 3 categories that are pretty much, corporations are put into. Not going to go into too much detail with other things because it could get a little bit more complicated than what I'm going to go over. We're just going to break down the differences between, a few of them, of how the IRS looks at it. And these are pretty much the main 3 ways that they're going to look at it. Like I said, we're not going to get into things like a trust and stuff like that. It's going to get really complicated. Mostly you won't need to know about that anyway, so that's perfectly fine. But let's kind of stick with the basics. So they're going to either look at you being taxed as an ordinary individual, which is what probably, I say about 80 to 90% of you are going to be classified as. Then they're going to look at probably, taxing you as an LLC for those of you who, have one and, pretty much use that as a business. You can, be taxed as that. Then you can also be taxed as a corporation, particularly in this case, an S Corp, not necessarily a C Corp. And we'll cover the differences between those here in a second so you guys can kind of get a better understanding of everything, okay? Now let's first start off with being taxed as an individual. Now, like I said, most of you guys are going to be taxed as an individual because that's just how it, it's going to be for you. You might be trading with like a smaller account or, don't have quite enough funds to be kind of considered a business or anything like that. But again, majority of you will be taxed as an individual, and there's nothing wrong with that. It has its pros and cons depending on, where you're at in life and in trading and things like that. So, some of the pros to being taxed as an individual is that it's easy to set up. You basically don't need to do anything, which is good. You just sign up with your broker, place your trades, go about life, and boom, pay your taxes when you're done. You don't have to pay higher broker costs on your platform. So if you notice that when you sign up with your broker, whether it be Thinkorswim, Webull, Interactive Brokers, et cetera, they do ask you, are you trading on, as an individual or are you trading as a business? Not many people know that when you decide to trade as a business, not only is it more paperwork, but you also pay higher fees for things. So that's one thing that's a pro, that you don't have to pay all those fees if you're trading as just an individual. Okay. Another thing is that you're not subject to self-employment tax. If you're, trading as a business, you got to pay self-employment tax, and kind of gets irritating doing all that stuff. That's more money coming out of your pocket. So that's another pro, that you don't have to worry about that as an individual. One of the cons is that you might miss on a lot of deductions. You might miss out on being able to have a lower tax rate. Um, and also, I meant to put on there too, you might be subject to more, you know, higher risk of being audited if you're trying to take like too many deductions and things like that. So that's just some of the cons of being able to do that as an individual. So, but again, you can still take advantage of different things as an individual, not necessarily being in business, but to each his own. Like I said, most of you guys will start off as being taxed as an individual, so you don't really have to worry about it. Now, being taxed as an individual doesn't mean that you can't take deductions that are there, because being taxed as an individual, you may also be able to qualify for what's called market-to-market election, true trader status. You might fall under that category, and we'll talk about that here in a second. So, as an individual, you can also have the ability to trade within your IRA accounts, and there's pros and cons to that too. Some people do this, some people don't. It varies from person to person. So some of the pros of trading within your IRA account is that allows you to defer paying taxes on dividends and capital gains. All profits can be reinvested without having to pay taxes, which is good. Obviously, there's a certain limit, but that's what you can do to kind of boost up your financial growth pretty quickly. Some of the cons is you might not be considered, you know, to qualify for the MTM status, because you're not allowed to borrow from your account. Some traders with their brokers, want the ability to short stocks, trade on margin and things like that, but you can't do that in an IRA because it doesn't allow you to borrow against it. Um, so that's just kind of one of the cons. You might not be able to do that, so you won't qualify for true trader status and be able to take advantage of other deductions. Seems like a lot, seems complicated, I know, but just kind of know, to each his own. Also, with the IRA, of course, you don't receive what's called a 1099-B, which is what you typically get from your broker to file your taxes. That shows your capital gains and capital losses throughout the year. You won't get that if you're trading within your IRA. You'll get a 1099-R, which basically shows the growth in your retirement account or the amount in your retirement account. Kind of hence why you don't have to, why you don't qualify for trading status, because you're, trading within your IRA. It makes sense when you think about it, but if it's a little complicated, don't worry about it. But you still have this ability to do this as an individual. Essentially here, that's what that is. Kind of one of the caveats with a lot of people might ask as well too, what if I'm trading within my IRA with a cash account that's large enough to meet day trading criteria? Because typically with an IRA account, you won't be able to qualify as a day trader because you won't be able to make enough trades, which is what we'll cover here in a minute. But if your IRA account is large enough to be able to do that, you probably shouldn't be trading within it anyway. You're still limited on the types of trades you can get, so you might not pass one of the qualifying criteria to be considered day trading within that account. So just kind of keep that in mind. So what are some things to consider as an individual trader? One, of course, is that you're potentially you're subject to the wash sale rule if you don't qualify for true trader status, and we'll cover what that is in a second. Another thing is you have to consider LIFO and FIFO orders when it comes to your broker. For example, what I mean by that is last in, first out, or first in, first out when it comes to your securities. Basically, if you brought 10 shares of a stock XYZ, then bought 5 shares of the stock XYZ, and then you decided to sell 12 shares of stock XYZ, is 10 plus the first, 2 coming out, or is it the first, the first, is it 10 of the first shares, that round of shares that you bought, and 2 from the last shares of last round of shares that you bought being traded first, or is it the first 5 and then the rest from the first share? That's something you want to consider, because that can apply to like the wash sale rule as well too. Um, you want to consider your tax write-off. So you're limited as an individual trader to be able to write off $3,000 of losses every year. Okay, for basically for an unlimited amount of time until the 3,000 amount is exhausted. So let's say, for example, if you lost $3,000, if you had a $3,000 loss in 2019, then you had another one in 2020, you can carry those years over. Or if you had $1,500 in another year, you can carry those over for an indefinite amount of time, but only up to $3,000 of loss you can write off. That's about it. No, that is it. No more than that every year. Okay, until it's exhausted. So you're limited there. And it's not a one size fits all. Every person's account is different. You know, definitely talk to your CPA or financial advisor when it comes to your trading of stocks. Okay. As far as the wash sale rule, a lot of people always ask, what is the wash sale rule? And it's pretty simple. I mean, I do another video on that, but to kind of break it down, basically, according to the IRS, it basically prevents people from being able to take, deductions on stocks that they sell, that would kind of cheat the system. It basically occurs when a person who sells a stock for a loss within 30 days buys it back again within that time frame. That's an identical stock to it. Doesn't necessarily be the same stock, but it could be a stock that's identical to it. Um, in order to kind of take a loss. So let me give you an example. Okay. Let's say if you bought 100 shares of stock XYZ on, like November 1st for $10,000. Then on December 15th, the shares went down to $7,000 and you sold it. So you sold it for a $3,000 loss, right? And you want to take that deduction for, tax purposes and be able to write that off. Now, come December 27th, in that same year, before the year is up, you go back to buy 100 shares of stock XYZ, and you reestablish your position in it. The initial loss is not going to be allowed for you to be able to take, because you repurchased it within that time frame. Okay, so that's pretty much how the wash sale rule works. All right, pretty easy, but not easy. All right, so we were talking about qualifying for a true trader status as an individual. You can do that. So it's called what's called true trader status. Basically allows you to do what's called a market-to-market election. All right. Now, according to IRS Topic 429, to be a day trader for tax purposes, you gotta make the market-to-market election um, on your tax form. Now, to do that, you got to file a statement no later than the due date of the original federal tax income return for the tax year preceding that election year, okay, that is applicable to. So to kind of give you an example, I know the wording can be a little confusing from the IRS, but to kind of give you an example, let's say if you wanted to qualify for a true trader status and make the market-to-market election, you have to file the form. I think it's 3115 that you got to do. You got to file that form the year preceding the year that you got to do the taxes. So if you want to make that election, if you wanted to do true trader status and market election in 2020 for your taxes, you would have to have filed the form 2019. Again, the year preceding, you need to make that election. Okay. That's kind of how that works. Now, in order to be able to take and make the market-to-market election, you got to be able to establish criteria that you are actually trading to make a profit, okay? And there's things that the IRS considers to make, there's things the IRS considers that you need to do to be able to make this election, all right? And I'll touch on those here in a second in a little bit more detail. But these are basically the criteria that they look for. You must be looking to profit from daily market movements in the price securities, not from dividends, not from interest, excuse me, or capital appreciation. You are trying to actually day trade, get in and out of the trade, excuse me. So as you can see, as a swing trader, it's probably harder to kind of, meet that criteria. Your activity must be substantial, and you must carry on the activity with continuity and regularity. It's kind of vague, right? I get it. We're going to break down how you can kind of get that criteria a little bit more, you know, specific for you. Um, but these are kind of the things that they determine when doing so. So they're going to look at, the holding period of the securities when you bought and sold them. They're going to look at the frequency that you're trading it. They're going to look at the extent, are you, how much are you trying to produce a livelihood with doing this? They're going to see how much time you devote to doing this, and the nature of which you do it. So they're going to look at all that. That's stuff that they're going to consider. Um, Keep in mind too that, just because, you qualify as a market to market trader in certain aspects doesn't mean that, you're going to get that true trader status. All right. You got to have pretty much all of it. Um, they're going to want to know if, the nature of your activity is considered to be either an investor or a trader. Doesn't matter if you call yourself that or not. They're going to look at all that stuff in kind of detail. So traders who choose to do the market to market election got to follow certain rules that investors can't. Okay. If a trader doesn't make a valid to valid market to market election under like section 475, you got to treat it as a capital gain and loss from the securities and basically report that on your schedule D. You don't got to worry about all that, but yeah. So if you don't meet certain criteria, basically understand they're going to look at it from an investor standpoint and make you pay those taxes accordingly. That's basically what they're saying. Okay. So, what is the easiest way to kind of determine if you qualify for the market to market election? I kind of put it in the simple acronym that when I do talk to some clients who do trade and stuff like that, I call it DATES. Are you making dates? And I'll break that down for you here in a second. Again, there's specific requirement that they look for within reason. All right. Now, obviously, it's a little bleak there. Um, but of course, this is some type of business. So they want to make sure that it is a business and not just a hobby or you're not just investing. You got to be actually running this thing as a business. So, for example, when it comes to dates, D.A.T.E.S., one thing they're going to look at is called the days. And they want to see that there's at least a minimum of 189 trading days that you're trading because there's a total of 252 trading days throughout the year. If you're trading stocks, this doesn't apply to like Forex, which is like 24/7 and all that stuff. We're talking about stocks, okay? Um, there's 252 days of the year that you can trade, and you need to meet at least 75% of those days to be trading. Okay, so they're gonna test that out. So days in the D in dates is the trading activity at least 189 days. Okay, amounts they're gonna see how many times have you traded within those days as well too. And this is where I teach you guys in the course and everything like that too. That scaling in and out of positions benefits you as well too, because they want to see volume. Like you gotta be doing it. They want to see, I think it's over 100, it's over 720 trades. Now, what do you mean by 720 trades? Basically, one buy order equals one trade. One sell order equals one trade. So typically, when you're buying and selling a stock, that's two trades. But that's why scaling in and out can actually, help you out. So let's say if you got into a trade, bought, 5 shares at X amount of dollars, then you bought 10 shares at X amount of dollars and you sold all 15 shares at X amount of dollars, that's 3 trades. You did 2 buys and 1 sell. So hopefully that makes sense to you. But they want to see over 720 of those and a minimum of 189 days. So kind of keep that in mind. Now, timed. How much time are you devoting to, to your craft? Are you actively, doing this? They want to see a minimum of 4 hours. That's a minimum. And this includes things like, research and uh, practicing, back testing, actual trading. Not just it's not just based on they want to see you doing 4 hours plus of trading in and out of stocks. No, you can do research, you can do testing, a lot of things you can do within the time frame. You got plenty of time because I mean, if you think about it, pre-market starts at 4 a.m. Eastern time, and after hours as well too closes at 8:30. So you got like a whole 16-hour time frame to consider of working on your craft. And you guys know me and how much I trade. I'm usually up at pre-market at 1 a.m. Pacific time, and I'm done, trying to be done usually by 8 or 9 o'clock. But sometimes it goes on that. Sometimes I have long days and I'm trading. It depends. But yeah, you typically have no problem with meeting that requirement when it comes to trading. That's usually easy for everyone. Um, Next thing they're going to look at is the expenses. What type of operating expenses do you have to run your business and trading? Are you paying margin fees? Are you paying for scanners? What kind of ongoing activities are you paying for? Operating expenses, pretty simple. They want to know you have business expenses when it comes to that. Then they're going to look at supplies, equipment. What are you using to day trade? Like for me, guys, I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I have about 10 monitors. I have a heavy duty computer. Then I have a tablet. I know some people trade from things like their phones and stuff like that, which is fine. But they're gonna want to know, how legitimate is that? Like, I'm, my trading and stuff like that is dedicated to actually trading. So I would meet that requirement. They want to know that you're, have equipment that's specifically dedicated to your business. Pretty simple. So you need to have that intent to operate your business as a business, which is something that's, considered as well too. Another thing with that is, the PDT rule kind of prevents a lot of individual traders from being able to meet that requirement too, because of the fact that, there's 189 trading days, and it's going to be really hard to meet trading in and out of stocks every single day when you're limited to 3 trades every 5 days, you know. Um, if you're not familiar with the PDT rule, I'll do a whole video on that, but just understand that. So accounts that are $25,000 or less usually don't really fit that market to market election, okay? Whether you're a business or an individual, because they want to see that consistency in 189 days of trading. It's hard to do that when you're limited to how many times you can trade every day. Now, if your cash account is large enough to do that, that's great. Um, some people have cash accounts, where they clear the T1 rule, like, in options accounts. Um, it doesn't, another thing that people get mixed up is that trading doesn't need to be your main source of income. Like for me, it's not. It's a big contribution to it, but it's not my main source of income. I have other things as well too. So you can still make the market to market election if you have a job, another full-time job, but still trade quite constantly. I get that a lot of times with clients. Another little caveat is that IRAs do not qualify for market to market election. Um, you know, Brokers might inform you, the amount of trade that, sometimes too, that you need to be classified as a business. So, for example, let's say if you're a scalp trader, and if you've done like 300 plus, trades and your account reaches a certain amount too, your broker might say, hey, the number of trades you have exceeds the amount for an individual. You need to classify your account as a business account. So a little golden nugget there. Understand that for you scalp traders out there. There's nothing wrong with it. Just know that if you got to change to a business account, you have to pay more for stuff. So little side note there. But these are the qualifications to make that market to market election, to be qualified as a true trader status, to be able to take advantage of different tax breaks and stuff like that. that you won't qualify for as a regular individual trader. So, like I was saying, some of the market-to-market trader benefits, pros and cons, it varies. And this is according to IRS topic 429, to qualify for this status. The cool thing about the market-to-market election as well, too, you're exempt from that wash loss sale. So if you have a year where you have a massive amount of loss, you lose like 5, 10, 20, whatever. You lose a couple thousands of dollars. You're not limited to just taking a $3,000 loss. You can take off more than that. So that's one of the benefits of the market-to-market election. Um, you can have an unlimited amount of losses, and you report that on your form 4797, which is pretty cool. So understand that. It's one of the major benefits of the market-to-market elections. Let's see here. Yeah, that's pretty much it. That's the simplest way to kind of put that so you guys aren't confused. Don't really need to go into any more detail, but kind of understand, in other words, like when you close out the year with a net loss, you can offset, ordinary income with that loss without having any kind of limitations. So that's pretty cool. Um, you can have it starting from 2021, and it can be carried forward indefinitely. Um, Net operating losses occur, can be carried back 5 years and then forward. So let's say if it's 2021, you can go all the way back, to 2018 and beyond, or 5 years from that would be like 2016. So yeah, so you can carry forward those losses from that year all the way indefinitely, which is cool. So you're not limited to $2,000, and that could save you a lot of money in your taxes right there, because it's going to put you in a lower tax bracket. So that's just kind of one thing to consider. All right, so I know that's a lot of information. Let's quickly recap this stuff here and what we talked about. So we talked about the different ways that you are taxed. You are taxed as an individual, you can be taxed as an LLC, and you can be taxed as a corporation. Again, most of you guys will probably be individuals. We talked about the pros and cons of being taxed as an individual. You can go back and revisit that slide. Less paperwork, less hassle, but you're only limited to, $3,000. You're stuck with the wash sale rule, blah, blah, blah. We talked about trading within the IRA. We talked about the pros and cons of doing that. We talked about the wash sale rule and what it is. Um, you know, Buying back a stock within 30 days that's similar and trying to take the loss, but you can't because you bought it back within 30 days, blah, blah, blah. We talked about the amount of losses you can write off in a length of time as an ordinary individual. You have up to 3 years as an ordinary individual. You're only limited to 3,000. You can write off indefinitely, carry it forward. Um, we talked about the true trader status and taking the market-to-market election, what it is and what the criteria is set for it. Dates, remember, days, amounts, time, expenses, supplies. And then we talked about the status, the benefits of having a true trader status and taking the market-to-market election, being able to write off all those losses, not being subject to the wash sale rule, lowering your tax bracket, saving you some money, things like that. Quite a lot, I know, but we're going to take this time to recap. We're going to take a little break here. Now we're going to go into a little bit more detail on trading and taxes. All right, guys, we are back at it. Quick little break. So we already went over um, pretty much being taxed as an individual and being able to elect the market-to-market status. So now we're going to go into a little bit more detail here with different tax saving strategies. Okay, so trading as a business. This is pretty much the other route you can look at as far as being a day trader and being able to have some tax saving strategies, trading stocks as a business, which is what most serious day traders like myself and others do. So we're going to break down the different entity types and talk about different strategies and deductions, kind of the meat and bones of this video. So get ready to probably take a lot of notes here. Listen carefully to what I'm saying. I'm going to try to break it down as simply as possible. And hopefully learn a little bit more. Okay. So trading as a business, understand there are different business entity types. Okay. This will help determine how your business is going to be looked at being taxed. Okay, so let's kind of go over the different business entity types. There's LLCs, or also LLPs. LLC stands for a limited liability company. And then LLP stands for limited liability partnership. There's single member LLCs, there's multi-member LLCs. I won't go into the different details of that, but just for general purposes, just kind of understand that, that exists. Then there's corporations, where you can elect to be a C Corp status or S Corp status. For this video purposes, we're not going to focus on C Corps, because I'm pretty sure 95% of the time you guys aren't going to be, a C Corp. So here in this video, what we're pretty much going to focus on is LLCs, and S Corps. And we'll talk about those different strategies here. But C Corps and LLPs, we're not going to worry about, throughout this video. Okay. So oftentimes I'm asked, is it better to trade as a business, or, can I save more money, by trading as a business? I mean, the short answer, of course, is yes. But also too, that would depend on how much you trade as a trader. The biggest thing that you probably want to focus on is the amount of time that you're trading. And, trading under a business, excuse me, most people kind of get confused with, that being like the all in all tax savings. If a lot of people, hear them say, oh, if I trade as a business, I'm going to save myself tax wise. That's not necessarily the case. Mainly what setting up a business does is limit your liability and exposure, to legal things. Not necessarily having a business or incorporating a business is going to save you tax wise. For some reason, people get that confused. I don't know why. I mean, I get why, but yeah, it's not the case. Mainly setting up a business in the LLC will limit your liability exposure, not necessarily give you tax break savings as you would if you were self-employed or just doing stuff under your name. So just kind of wanted to clear that up. Um, of course, there's more reasons, than that, but that's just kind of like the main general point, um, of doing that. So, with kind of note as well too that having a single member LLC, you got to pay things like self-employment tax as you would if you had like an S corp or LLP and stuff like that. So it just mainly protects you in terms of liability. So that's pretty much what we're looking at here. The different entity types that you guys want to focus on here is LLCs and S corps, and we'll talk about those here more in a second. All right. Now, as a business, the IRS is going to look at either the business itself being trading as investors, trading as traders, and having like the market-to-market election, or trading as a dealer. I won't go into too much details of the dealer side because you guys aren't going to be worried about that because you're not going to be dealers. Well, I mean, I'll touch on a little bit, but not too much detail. Okay. So, I mean, dealers are usually, taxpayers that are normally treated as dealers. They don't have like customers, but they trade their own accounts and are treated normally as either investors or traders. Most of the time, controversy arises over the status of your business when they disagree on like the characterizing your gains and losses from selling your stock. That's where usually the discrepancy comes to whether or not your business is operating as an investor, as a trader, or as a dealer. Okay. Um, Now, understand as a dealer or as a trader as well too, you can do it as an LLC or an S corp, whatever you choose. You just have to continue to make that market-to-market election to qualify for all those deductions that you want. So you can't just like incorporate yourself, become a business, and only trade here and there and still think you can take the deductions you want. You still want to meet that market-to-market election. And don't worry, if it's confusing, it's going to, I have a chart here in a second that's going to break it down a little bit more easier for you guys to be able to understand. Okay. Um, but again, understand for the most part, you guys aren't going to be dealers. That's usually like companies, hedge companies, and stuff like that, that deal with that. Um, you would, you know, not have to really worry about that as a avid day trader if that's what you plan on being. All right, pretty simple. So again, IRS is going to classify your business itself as either an investing trading business, a business as traders, or business as dealers. And you can kind of look into those details a little bit more on your own, but just kind of know that. So people always ask, well, why would I trade as a business? Again, you'll get more savings. You'll have less risk of being audited. Of course, you could be your own boss. That's a benefit for a lot of people. And it's really the best, tax and legal treatment that you get, being able to trade as a business and meeting that market-to-market election as a business. That's kind of like the best of both worlds. Um, so a lot of people always ask me that too. Why would they trade as a business? So again, keep in mind that you still need to meet that market-to-market election criteria, um, because you want to be seen as a business. And if you don't, you'll just be kind of seen as like an investment firm, and therefore not trading as a business. So you wouldn't really be able to get those unlimited, deductions and capital loss write-offs that you get as a market-to-market election. So there's a reason why I progressed from trading as an individual, being able to take that market-to-market election, and now trading as a business, and still being able to meet that market-to-market election to be able to get those tax savings. So you're kind of wondering, well, where does the benefit come in to trading as a business and making the market to market election as opposed to trading as an individual and making a market to market election? Well, the biggest thing, again, not only are you limiting your liability, um, as a business versus an individual, but also, too, again, the tax treatment that you get. So, for example, um, you want to, ideally, incorporating your business as an S corp is better, so you can take those tax deductions, and this is where the tax savings come in. So this is probably where a lot of people get confused, like, oh, if you start a business as an LLC, and you'll get a tax break, but you just want to elect it as an S corp. And I'll break it down to you guys, like how I did mine as well too. um, so yeah, you want to be taxed as an S corp, not as a LLC, especially not as a single member LLC, because you're still subject to self-employment tax. Whereas if you are, incorporated as a business, and elect an S corp status, you'll be able to give yourself a salary, and you can contribute to 401k, which will give you more tax savings from your profits. It lowers your tax liability and saves yourself, hundreds if not thousands, depending on your tax bracket. Um, so that's one thing that you can't do as a single member LLC, is, give yourself a salary, because you're, at that point considered self-employed, and you don't really get that benefit as a individual trader, even if you do take the market to market election. So that's like another benefit there. I believe you can contribute up to about $57,000 in profit to a 401k. So imagine saving yourself $51,000 as a business, as opposed to doing it as an individual, or even as an individual, taxed as a single member business. That's why you want that S corp status, to be able to do that. You can optimize your deductions as an active day trader as well too, um, because of the fact that you have, the ability to pay yourself a reasonable salary. You want to make sure it is a reasonable salary, not nothing, where you're trying to pay yourself $10 and, write the rest off, kind of thing. It can get a little bit more complicated, but understand that you got things like paying yourself a salary, contributing to 401k. Um, you got healthcare deductions you can take. It's a lot of things you can do, as a business, that you couldn't as an individual taking a market and market election. Okay. Um, so hopefully that kind of clears that up. All right. Especially with the fact that if you have a big loss, you can still, write that off in the tax year. So that's why you want to treat it as a business. Get all those tax treatments and legal statuses in play all in one nutshell, but make sure you're setting that thing up correctly, not just filing articles of incorporation and becoming a business. So again, here's just kind of a brief list of things that you can deduct as a business when you do make that market-to-market election, um, that you qualify for. So some of the things you can write off is like your margin fees, data fees, software subscriptions, any newsletters or newspapers you get, trading books and publications, cell phone service, internet service, going to seminars, and that includes, of course, transportation and lodging. Excuse me, webinars that you might attend that you got to pay for, wages you might pay your family members, rent if you're, leasing the space to go trade, your home office, cable fees, electricity, utility, computer and office supplies, computer trading stations, computer software depreciation and expenses. You can do the 179 assets depreciation. You get margin interest and locate fees you get to write off. Legal fees and incorporation costs you can write off. Food, energy drinks you can write off. Tax preparation and consulting you can write off. Chat room and subscriptions. So yeah, those of you guys that are subscribed to the chat room and alerts, guess what? That's a tax write-off for you. So that's good. And then, whatever reasonable thing that might be required for you to operate in your trader business is basically something you can deduct because it's the operating expense that, you pay to run your business and become profitable. Whereas if you were an individual, you can't write most of that stuff off. To a certain extent, you can, but not everything is easily. And plus, you'll be more susceptible to being audited because they're going to think that you're just trying to take a bunch of write-offs. Whereas if you're a business that's incorporated, they already know that you need these things in order to operate. Pretty simple. So this guy's right here is a quick little chart that kind of breaks down the differences between, um, you know, being an investor, being a trader, being a business, and being a business that takes the market to market election, and being a business as a dealer. Okay. Um, this chart here isn't mine, of course. It was referenced from the taxadvisor.com. So if you want to go check that out on their website, you can find it there. Um, but it just kind of breaks down the different treatments. So you might be looking at this here and seeing that, so this right here is an investor as a regular individual. This right here is an investor as an individual who takes the market to market election. This right here is a trader as a business. And this right here is a dealer as a business. You guys, again, won't need to worry about this category, but you'll see too that the dealer column, along with the trader column as a business, these two here are kind of the same when it comes to the different, tax treatments, which ideally makes sense. Um, Again, you guys won't be dealers because you're not, market makers or anything like that, or running any hedge fund companies. So you really won't have to worry about this column here, but mainly you want to worry about these three here and looking at the differences between them. Again, these two here are as individuals. This right here is as a business. And so you'll see that you get much more benefits here as a business, especially when you elect the S Corp status, than, as opposed to being just a regular person who trades on a day-to-day basis or trading as an individual who takes the market election. Okay. Keep in mind that a business that's a single member LLC will more than likely fall under the trader as a market election, as opposed to a business ran as an S Corp and pays salary and things like that that gets to fall under this section here. So that's something you can kind of take a look at, notate, screenshot, whatever you want to do. All right. So what are the pros and cons to having an LLC or even S corp as well too? Pretty simple. One of the pros, some of the pros is that you get to take more deductions than you would as you were an individual. You have less risk of being audited. You have much more tax savings and more chances to profit. Um, some of the cons, of course, is that you may have a little bit more paperwork, keeping track of, all your expenses and things like that. It could be a little bit more of a headache in a certain extent, as opposed to just, being an individual and trading. Another con is that, it might be more expensive initial costs. For example, when when you're elected as a business and you need to sign up with your broker, you may have to pay, more fees, higher fees because you're trading as a business and not as an individual. So kind of keep that in mind too. But overall, in the long run, it's much more beneficial to do so. And this is just a little bit. This isn't like, every single thing. Just want to kind of give you guys an idea. Okay. All right. So what we're going to do here real quick is go over some of the questions you guys sent me. I'm going to try to answer these, as quickly and detailed as possible. And then we'll wrap everything up here. Um, so I got the questions you guys emailed me or messaged me, or, might have sent over to me or the admin. So I'm going to go through them here real quick and knock them out for you. Okay. So one of the questions here is, if you open an LLC as a trader, do you have to pay quarterly taxes or yearly taxes? Yes, because it's a business, you have to do that. So understand that. If you don't know that, as a business, you pay, quarterly taxes. Um, so every 3 months, 4 months, yeah, every 3 months you pay taxes. It's pretty simple. Next question is, can I do this even if I don't qualify as a professional day trader? Um, Not quite sure what you mean by can I do this. I don't know what this is. But I'm going to assume you mean opening up an LLC. Yes, you can open up an LLC. Um, if you do open up the LLC, you just might not qualify as a day trading business. That's the thing. So you can open up an LLC and have a business and still trade. You just want to, understand that you might not meet that market to market election where you can deduct certain things like margin fees and subscription costs because they'll be like, oh, your business isn't a trading business. You just have a business and you're trading under it. It'll be considered more like an investor as opposed to a trader. Hopefully that makes sense. But again, speak with your financial and legal professional about that. So next question is, at what point would you say it would behoove me to incorporate my trading into one of these entities? I would say once you start making a significant amount of capital where you need to start looking at tax saving strategies that you would want to do that. Maybe around maybe 30 or 40,000. You probably want to start looking at, doing that, especially if you're consistently profitable, because hopefully from that point on you start growing and making more money. But yeah, I would say around then you probably would want to start looking into it. Don't quote me on that. Again, it varies from person to person, but just look at it when you start to get to the point where you're making a lot of money to where you need to start looking at the tax saving strategies. Next question is here. Does the LLC or trader must get a FINRA license to do what was described? Let me pull this up here. I don't think so. No. The only time you would need a FINRA license actually is if you are doing this as a dealer, and you guys aren't dealers, okay? If you plan on being a dealer, then yeah, you would need a FINRA license, but not if you're just trading as a business. Um, but again, speak with your financial legal professional about that as well too, to make sure that it fits you. Next question is, I was wondering, do the same tax laws apply to crypto trading as well? Yes, it does. In the definitions of securities and investments, like I told you guys earlier, how I was just going to focus on investments, meaning stocks, crypto will be considered that as well too. Even crypto has its own other whole other tax stuff. I might do a video on that, but I don't know. We'll see. Um, Next question is, when filing an S corp, would there be a difference between a single member LLC and a multi-member LLC? Yes. Um, Best way to kind of break that down. So with the single member LLC, of course, it's just you. With a multi-member LLC, is you and other people. Um, so there's that difference. And of course, with the S corp status, when you're filing as either a single member or multi-member, just decide if you're going to have other people with you or other people not with you, because you can do it either way. If you have a multi-member LLC and you do it and you elect as S corp, you guys got to understand with the S corp, you want to make sure you have what's called SOPs, which is standard operating procedures, and you want to have those, addressing different things in your business. It legitimizes your S corp much more, so understand that. Um, but yeah, that's pretty much the difference. Is just having more members in the business as opposed to a single member LLC. Okay, pretty simple. Now let's say, for example, you can have, let me kind of break this down. So you have single member LLC, you have a multi-member LLC, and he's talking about when filing the S corp status. The difference between that is if you didn't elect the S corp status, that money that you guys make from the business will be considered self-employment income for either the single member or for the multi-members. Let me see if I can kind of get an idea and draw it for you, because that might actually be easier. Let me see if there's like a snippet tool on here real quick. Or not a snippet tool, I can do like a paint or something. Let me see. That way I can draw it for you guys to understand what I'm talking about. Let me load it up here. Sorry about that. Okay. So what you're saying, let's say if you have a single member LLC and you have a multi-member LLC, you guys understand you can elect to file it as an S corp, right? And then you have a single member LLC and a multi-member LLC that you can choose not to do it as a S corp. Okay. If you decide to do it as an S corp, understand you would, pay yourself a salary. I'll just do like this. Or if you do it as a multi-member LLC, you could pay all the members a salary. Blah blah blah. Let's just pretend that's like a bunch. This is the ugliest thing I've ever done, guys. So just bear with me. I'm just trying to make this go fast for you. In this section here, where you have everything as a single member or multi-member LLC as a S corp, all you guys will be, you guys wouldn't be subject to, like self-employment tax, or, you can also, you would basically, this money you get will be as a salary. You can do other things like 401ks, blah, blah, blah. Now, if you don't elect the S Corp and you guys get paid your money, you're basically just going to be having extra income tax as ordinary income. That's all. So you don't, and here you would pay self-employment tax on that income that you get. You would pay other taxes. So that's really the difference. Having S corp, not having S corp, between the difference between the two. Hope that makes sense. Next question here. I probably should have kept that up to be able to explain other stuff. But anyways, what are the basic differences between LLC and electing the S corp and a partnership? I hope I just kind of broke that down for you guys. Kind of the same question, really. It looks like between those two. Someone else said, uh, what happens if it is sold as a loss? I'm assuming you mean the securities. Um, Basically, if your stock is sold at a loss, you just have a deduction. That's it. Um, Hope that answers your question. Next question is, do you have to enable day trader status in order to take advantage of these take tax advantages, or will you need an LLC plus S corp? Also, I have an LLC S corp, but I don't think I'm too late to elect the status for the year 2020. In this case, will I need to just select the day trader status from March 2021, or how many trades do I need to take in order to year? It's a loaded question. Okay, um, so let's kind of break this down here. Do you have to enable day trader status in order to take advantages, in order to take tax advantages, or will you need an LLC that plus S corp? Again, that just falls in lines of meeting the um, market to market status. So in order to take full advantage of, these tax savings, yes, you do need to elect the day trading status. Um, Also, they have an LLC and an S corp. Is it too late to make the day trading status for the year in 2020? Remember, you have to have it set up for the preceding year. So if you were trying to take it in 2020, you should have had it set up in 2019. It's possible you may be able to do an amendment. I have to double check on that, but also speak with your financial professional. But you should have had it done in 2019. But if not, going forward, you need to elect it before preceding year. Okay. Um, Someone said in this, and then he said in this case, I just need to select day trader stats before March 2021. Yeah, you should have done that. How many trades do I need to have in order to make? Again, you need to have 720 trades, 100 per year. So you might not meet the frequency if you only have 100. Now, again, yeah, you may not meet it because it depends on the frequency of trading. Remember, A in the dates is the amounts of trades, and you ideally want to have 720 plus. Okay. Remember, one trade is placing one order. All right. So hopefully that kind of breaks that down and answers that for you. So again, check with your financial professional to see if you meet the statuses to be able to do all that, but it doesn't seem like you would. And going forward, you want to make sure you're making that market to market election. All right. All right. Next questions here. Should I open an LLC now in December, or should I wait in for 2021? And these are old questions, guys. Also, single member LLC. I'm assuming you guys are talking about the upcoming year. So, also single member LLC, S corp election sufficient enough to save taxes and pay myself a salary. I'd wait if it was December, you were trying to wait. You might as well just wait because you're gonna have to pay for the whole year. And why just pay for 1 month? I'll just wait until January and then open the LLC. And as a single member LLC with the S corp election, is it sufficient enough to save taxes and pay myself a salary? That's what I do. I'll break down that for you guys. Mine's is a single member LLC. Well, actually, it's a holding company, so it's not really like that. I'll explain it in a second. But anyways, um, depends on how much you make to decide if it's enough to pay yourself a salary. Remember, it has to be a reasonable salary. You don't want to pay yourself like $0 and have your S corp profits be like 300K. Make it reasonable. Number two, will I pay taxes on stocks that I don't sell? What if I just leave it in my brokerage account? Hmm. Okay, first question. part of that question is, will I pay taxes on stock that I don't sell? No, you will not. That's an unrealized gain, and you only pay taxes on realized gain. It's an unrealized gain because you didn't sell a stock. You still have it sitting there. And if you did sell the stock and it's just sitting in your brokerage account, you would pay taxes on it because it's still liquid. You can cash that out. But if it's not sold and it's sitting in your account, excuse me, then you won't pay taxes on it. Hopefully that answers that question. Oh, excuse me. Do you qualify for day trading status in order to take advantage of the S corp LLC? In other words, I'm someone who trades part time as side time as a hobby. Can I still take advantage of the LLC? You kind of just answered your own question. If you only trade it as a hobby, they're not going to take it as a serious business, and you won't be able to do that. But if you trade part time and you meet all those qualifications, then you can. Um, you can take advantage of the LLC without being a day trading business LLC. So yeah, to a certain extent, you could take advantage of the tax savings, but not fully. So again, that you'd want to check with your financial professional as well too. But for the most part, if you're knowing that this is a side hobby, if you're not meeting those MTM or true trader status, you're not going to be able to take advantage of all those deductions. I mean, you can still operate as an S corp, pay yourself a salary, but you can't be classified as a trading business. So therefore, you might not get the ability to write off all of the losses that you have if you have a substantial amount of loss. You might be limited to the 3,000 cap. So keep that in mind. A lot of talking here. All right, we're almost done. So trading under LLC doesn't mean I have to open a corporate trading account in my broker. Typically means higher fees, more paperwork, etc. Can I keep a personal trading account? Uh, yes. You'll have to use the business account with your broker first and foremost. You do have to do that. Um, if you don't do that, so let me break this down. So you don't have to do that, but you if you want to take advantage of the corporate savings and stuff like that, or the business savings, you have to designate your broker that you're a business. You don't have to do that in order to trade and still qualify. You can still do MTM status, but if you don't decide to trade as a business, you can still do it as an individual and elect to make that market to market election. It's just a possibility that you might have you know, more chance of audit exposure. So you just want to make sure you're meeting those MTM qualifications. Again, that's something you want to check with your CPA with too, or your financial professional. Um, you might still be you won't get like the tax rate breaks that a business would if you don't as well too. So that's kind of a tricky question. You don't have to open a corporate trading account just to be able to take advantage of all those deductions. You can still meet the market to market qualifications, but you'll just be subject to a higher tax rate, if that makes sense. So it's not required, but you can do it. You really would want to check with your financial professional to see what's better for you. Is it better for you to bite the bullet and pay a higher fee with your broker, where you can at the same time save on corporate tax rates and have less risk of being audited and more savings, as opposed to just keeping it paying nothing with your broker, trade as an individual, but still be subject to a higher individual tax rate and still have the deductions with the market to market election. That's pretty much how that would play out. Do I need to designate my brokerage account with a business? Wait, did we just answer that? Or was those the same questions? Kind of the same questions. Do I need to designate my brokerage account, which is personal to business, for MTM filing purposes? You guys are smart. Um, for the 75 election, I think it I think it requires to identify brokerage accounts in addition to an EIN. Again, yes, in order to do that, you need to designate your account as a brokerage account. Okay, for your business to be able to select the MTM filing status. Okay, your business has to be incorporated with your broker. If you're asking me the question I think you're asking, because you can keep it individual and select the MTM status as an individual. That has nothing to do with your broker. But if your business itself wants to qualify for that MTM status, you do need to tell your broker that you want to set your account up as a business account. Because you can't say, oh, I'm gonna have an individual account but have an S corp in a business that's designated for trading. The IRS is gonna be like, no, this is in your personal name, not your business name. Your business doesn't trade. Kind of look at it like that. And yeah, it does require you to have an EIN and stuff like that. And I'll show you guys how to do all that stuff really easy and get it done quickly. Last two questions. Do I have to have a trading business account with an LLC already set up, or can I set the LLC after I sell your assets as an individual? You can always do it later. I would double check with your broker. Um, you're not required to, you know, I think they allow you to change it at any point in time. Um, you don't have to have it like once you set up with your broker. You can always change it, but double check with your brokers to make sure. And then last question here, how do I show these trades on my tax return? Easy. It's going to be under basically what happens at the end of the year. Your broker is going to send you what's called a 1099B for barter. Because get it, you're trading, you're bartering, you're bartering. Yeah, they're going to send you a 1099B, and basically you're just going to input the summary tabs of you know information on there into your broker. You don't really have to worry about that if you're not, unless you're doing taxes personally. But usually, if you take it to a CPA or whoever's doing your taxes, you provide them with a 1099 Form B that you'll get from your broker. And brokers like Robinhood or Interactive Brokers, Webull, all those brokers, they'll have those tax documents prepared for you. I think they'll have to be done before January 31st, but they usually have them pretty early, so you can take those to your accountant or CPA and get those knocked out. Okay. All right, guys. So my last little tips here for you is pretty simple. Don't worry about your tax obligations when it comes to trading unless you start to make big money. Um, if you see yourself being consistently profitable in trading, it's just going to snowball from there. As it gets bigger, then you want to start focusing on different tax saving strategies. Okay. If you ever have any question about, whether or not, you know, this qualifies for this or this qualifies for that, or can you do this or can you do that, or if you actually do something and you're wondering what's going on, what would happen in the situation tax, the tax situation with this, ask yourself this: if you were to get an audit from the IRS underway, would this meet their requirements? So if you ever have any question, always ask yourself that. How if a third party came and asked me about this, would I be able to explain this, and does this meet their standards? Really the best way to look at it. Um, Another tip for you guys I always recommend for people too is always good to speak to more than one financial professional in regards to your situation, just to kind of see what kind of answers they get. Usually after two or three people telling you the same thing, it is what it is. Unfortunately, accounting and tax and stuff like that is subject to interpretation, and you want to get points of views from different people, different professionals, to kind of make sure it's all concise and consistent. um, so that's really a thing that people kind of overlook doing, because you could have three different accountants doing three different doing the same work, and they'll all come up with different numbers. Unfortunately, sometimes that does happen. um, every person that's educated is different. Even myself, when what you're taking from this video, you can run that by your tax professional. That's why I tell you guys to do that. It's always good to get a different point of view. And lastly, another little tip for you guys, if you're looking at incorporating your business or starting a business, whether it be trading or just a business in general, I recommend a lot of my clients to go to fastbitstartup.com. They set it all up for you for free. I think the only thing you got to pay for is like the filing fee for your state that you file it in. But for them to do it and process it and make sure everything's set up correctly, it's all done for free. So go check them out if you plan on having a business, LLC, S corp, whatever you want. Even if it has nothing to do with trading, you just want to start a business and be an entrepreneur. I recommend going there, getting it done. Don't have to pay anything. You can easily set up your own business yourself. I tell people all the time, basically what you do is, you go to your Secretary of State, whether it be on the website or whatever. You're going to file articles of incorporation to establish your business. Once you got your articles of incorporation, you then go to irs.gov/EIN, get an EIN for your business, make sure your business names match, because if they don't, it'll be a headache. And voila, you have yourself a business. But if you don't want to waste your time and have to deal with all that, just go to fastbitstartup.com. They do it all, make sure it's all correct for you. They have other services and stuff like that, but you may not need it. but it's good to kind of check out. And that's pretty much the easiest way. I've had clients who set up several different businesses with them. It's really quick and easy. It takes about 1 to 3 business days for them to get it done, and that's pretty much it. Another quick thing I like to leave you guys with, because a lot of you guys ask me how do I set my up as a trader. Basically, the way I do it is I have a holding company, and in that holding company has several different businesses. Excuse me, several different businesses. I usually say it's good to have two or more entities set up underneath your holding company. So from there, I take the profits from one of my companies, my trading profits from one of my companies, and give those profits to my holding company, where I'm paying less amount in taxes, and paying myself a reasonable salary based on my trading performance that during that time frame. Again, don't do $0 because that's not you know realistic. And the reason why I do that is because my business is taxed much less than an individual. So it's better to run those profits through my business and let my business pay taxes on it as opposed to me having to pay taxes on it and saving myself money. All right. So that is pretty much it, guys. I hope you enjoyed this video. If you have any questions, let me know. Sorry, I was trading earlier. Let me close this out for you. Yeah, let me know if you guys have any questions about anything. And other than that, stay green.